What's good, guys? Today I will be teaching you about gaps. I'm talking about new day opening, new week opening, new month opening gaps. If you are unaware, the stock market closes each day, and oftentimes these gaps are formed where it's like price closes here and then the next day it opens here. And there's daily gaps, there's weekly gaps, and there's monthly gaps. Daily gap right here. Weekly gap, just going on weekly and finding a gap. And then monthly gap right here. Close right here, open right here. The only difference between weekly, monthly, and daily gaps is really that, it closes on a week and the new week opens higher, the new month opens higher. It's just that higher time frames again hold higher power. The probability that a monthly gap occurs is way less than the probability of a daily gap occurs. Like, see, there's a ton of daily gaps. Wherever you look, there's a gap. Gap, 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 gap. There's a ton of daily gaps, and so you can't really pay attention that much to them. And monthly gaps, it's a lot rare. There's one gap maybe in the entire 40 years that Microsoft has been traded using TradingView. But yeah, basically that's pretty much like the tutorial on what are gaps. It's just when price closes at one place and opens higher or lower, it could be a gap to the downside. When price opens higher or lower than its previous close. And because these are stocks, they're not traded 24/7, there's going to be gaps. Basically, what are gaps? Why are they useful? Why are they anything, really? Gaps are just another reason for price to go a specific direction. Gaps are just another reason for price to go a specific direction. A gap is a price range where there's 0 orders in this area. There were orders here, price was climbing, and then boom, price ripped for some reason. News happened, whatever, the next day price opens here. There are 0 orders in this price range. Market makers want to fill these imbalanced price range and create orders. They want to basically fill it with orders because they're like, okay, this is like a magnet for us. There are 0 orders here. So that can either mean one of two things. Either price is just gonna completely flow through this zone because there's 0 liquidity. So price is gonna very super liquidly flow through the zone, or price is gonna use this zone to fill orders. Sorry, I can't really draw much. Price is gonna use that zone to fill orders to then shoot itself to the upside. And so here's an example. Here is AMD. This is AMD on the weekly, so it's not a monthly gap, but monthly gaps are really rare. So most of the time you can just use weekly gaps. This is the gap that was formed on AMD. Day had a high here, and the new week had a low here. So the new week opening gap was this big, right? What did price end up doing? Price ended up manipulating it into the gap. Boom, had a really nice 25%, 32% retrace to the upside. What did price do? Went back in, filled some more orders, went deeper into the gap. Boom. Sorry, not done yet. Have to scroll up a bit. Boom. Went up 200%. Can you imagine AMD, a stock like AMD? You bought it the 9th of March. You bought it the 9th of March. And congratulations, June 18th. June 18th, it is 200% upwards from your direction. That is absolutely insane. And it is completely possible for you to do this because of gaps. You're able to bottom tick, basically, using gaps, using liquidity sweeps, using all this. Because most people are going to tell you, oh, wait for confirmation, wait for this, wait for that. Like I said, that has maybe a part to play in day trading, but this is investing. Like AMD is a trustworthy company. You can invest in AMD when it's down 30% from its all-time highs. You can invest in it, but not just stupidly. Don't just buy if it goes down. You have to buy it in smart places. And so let's see a combination. Looky here. We have weekly lows. We have weekly lows. What did I teach you? If you look at my low resistance liquidity video, or just liquidity video, I taught you about low resistance liquidity, lows that are stacked up on each other. And I said that if we find lows that are really close to each other, what is price more often than not going to do? If it hits one of the lows, it might as well hit all of them. So you could theoretically buy a little bit at each of the lows just to make sure you have some like paper in the game if it just shoots up immediately. But I would like to, buy lower and invest more capital. So I wait for the last low to get hit. So what did I do? I waited for this low to get hit. And then what do we have here? A gap. There was a liquidity sweep. What did price do? It entered a gap. What's over here? Previous all-time highs. No consolidation blocks at all, which is why you can see that price actually kind of created a consolidation block on its own. Like price just kind of consolidated down here for its own purpose. Yeah, like it just stayed in this little price range for a while because they couldn't react off another price range since there's no consolidation blocks here. Like I said, we could just use gaps as like further information to tell us, price is going to go upwards. And if you would have bought here, like I said, you would have been up a very decent amount. All right, let's go to Microsoft. Let's go to Microsoft. Okay, so Microsoft. Microsoft had this giant monthly gap. Now, usually when there's a monthly gap, it is a pretty safe bet to just invest at the top of it, and then if it fills it, at the bottom of it. Because like we saw with AMD, although it was a weekly gap, AMD had a top and the bottom of the gap. Well, what did it do? It hit the bottom of the gap. It hit the top of the gap, filled it in, didn't even touch the bottom of the gap. Maybe far, far, far in the future, it could retrace all the way down here. But the point is, you would have been able to already make a decent amount of profit if you would have bought it when it touched the gap. And so that's where we start talking about risk management and dollar cost averaging, like different places to dollar cost average. Now that you know all these things, you have the intro to the gap, the liquidity sweep, all-time highs. On Microsoft, I think it was a pretty decent bet to start investing at the start of this gap because that aligned with pretty much all-time highs in this very young consolidation block. Now, this is exactly what I meant. Sometimes you have to understand that these are long-term plays. When I'm saying that AMD went up 200% in 3 months and that Google went up 160% in, I don't even know, how long is this? I don't know, whatever, a couple months. You have to understand that these are very long-term plays. It was just incredibly lucky that, AI boom happens and memory boom happened and the stocks just thought up. But these are long-term plays. These are term plays that you could watch a couple years from now. You're going to be like super proud of yourself that you invested. And so you have to understand that this isn't something where you're going to invest and it's going to pop off. If that happens, like with IBM, good for you. Like that is super. IBM, literally, as soon as it hit it, it just popped off. IBM, a stock soaring 13% in a day. Then a couple days before that, 12.5% in a day. It's soaring after it hit the zone. But that's not always going to be the case. And Microsoft is a very good example of that. Microsoft hit this gap. What can we see? We can see a slight reaction off it. It wicked up. What did it do again? Went down. Hit the bottom of the gap. What did it do? Slight reaction off it. This time it actually had some daily green candles. What does that tell you as an investor? You, even though it kept on falling afterwards, you bought at the right time. That gives you confirmation that, all in all, you bought at the right time. These people were buying here. It was just falling. Yes, there was this little retrace, but what were you going to buy off of? Like nothing really happened here. But you bought off a good place, off a good zone, and price clearly had a reaction off that. Now, what do you see here? I don't know if you might see it. I don't know if you might not see it. What do you see here? Price keeps on falling down after consolidating a little. What does price hit? Boom. Price hits another daily gap. Price hits a daily gap, and now this is the final nail in the coffin. Yeah, it doesn't even sweep this low. Price hits the daily gap. This is the final nail in the coffin. From this daily gap, price shoots up 26%. It's not incredible gains like we saw with Google, like we saw with IBM, AMD, but it's very good gains. It's solid. And so if you use these gaps to your advantage, if you pair them up, again, you're not supposed to buy at a random gap. Because if you buy every time price touches a gap, a lot of the times price is just going to fall through. Investing isn't the hardest thing in the world, but it's also not the easiest because you have to remember 99% of traders fail. They lose money in the market. So you can't just buy every time it hits a gap. But you can if you see that, okay, gap, all-time highs, consolidation block, and then you see, boom, if I scale down on a lower time frame, I see that, okay, there's the end of the gap, there's another gap here, there's lows here, and you can, if you pair these all together, if you piece them together, that is when you can actually find a good investment opportunity. And what do I think about Microsoft? Microsoft is a very solid company. There's really nothing much to fear with Microsoft. It's what it is. If it goes down, it goes down. Stock market wanted it. What I'm looking for Microsoft is that even though I invested already when it hit these gaps, even though that happened, I'm looking for this low. Because look, if it hits this low, it aligns with two different sets of all-time highs. It aligns with two different sets of all-time highs. It aligns with two different sets of weekly consolidation blocks. And at the end of the day, where do I think Microsoft is going to be in 5 years? No one can predict it. No one can predict it, but someone can assume. We can assume that in 5 years, Microsoft is probably going to be trading higher. So am I going to be thinking, oh, I should have bought at a lower point? Or am I thinking I should have bought more? And in that way, I'm thinking that, okay, if Microsoft falls down another 9%, 10%, that is where you can put a large sum of money into it because you think that in the future, it is going to pay off tenfold. Let me just show you another example where it actually clearly showed that it's working. Here's Amazon. It's another example of a weekly gap, almost the same thing as AMD. This was just a market where I bought it. But we had this weekly gap. It's a tiny gap, but size doesn't matter. Why doesn't it matter? Because it's an imbalanced price range, so price just wants to fill it. Price wants the gap. Price wants to fill the gap. It doesn't matter if the gap is big or tiny or small or average sized, but it doesn't matter what size the gap is because the point is it's a gap. It's a price range where there's zero orders. So here, sorry, let me clear out most of these drawings. Here we have the start of the gap. Here we have the end. Even though these are super close to each other, you could have said, I'm going to buy some at the start, I'm going to buy some at the end. Because the fact that there's still a gap remaining is like, it's the little bit of risk that you're putting on the table that price might go down and fill that gap. But what can we see here? We have that little gap on the weekly. What can we see? What else can we see here? We can see that there was kind of this all-time high right here. So that aligns pretty well with the gap. This is why I'm telling you to focus on big name stocks. I'm not telling you to look at penny stocks. I'm not telling you to look at those random stocks. I'm telling you to look at well-known stocks, stocks that you believe in, like Costco, like Meta, like whatever, all those stocks that you believe in, like AMD. Stocks that you know that if you invest in this, it'll probably leave you better off. Probably. You don't know for sure, but it will probably leave you better off. And so Amazon, in my opinion, was one of those companies. Amazon, I think that if you invested in Amazon 5 years from now, you could be in a pretty decent position. And that is why that is one of the stocks where it touched the gap. Think about it. It is 23% from all-time highs. It touched the gap. It's probably going to react off the gap. I mean, there's just no going about it. It's probably going to react off the gap. And so what did I do? You would have bought it when price hit this gap. You would have been stuck in this little consolidation range. You would have been stuck. I mean, no going about it. But then, how many days was this exactly? Then suddenly, just a single month after you invested, in a couple of weeks, price would have shot up 40%. These people that invested here, they are in psychological turmoil. They're down 16%. Price is bouncing around, down 16%. You buying right here, apart from this tiny wick that is minus 1%, you would have felt no psychological turmoil. You would have been floating 7% profit most of the time. And then price shot up 40%. You're not only giving yourself more money by investing like this, by giving yourself more of a shot to invest lower, get bigger percentage returns at the top, you're giving yourself less stress. And I feel like that's a very underrated thing. Like you could have very well invested at the top here because you would have been like, oh, AI is booming. Look, I don't think you would have even looked at these gaps. You would have been like, AI is booming, or whatever, cloud storage is booming. I'm going to invest in Amazon. And you would have been down 23% on your investment. Like that is going to take some pain. And then perhaps here you'd be like, that's it, I give up on Amazon. Like this thing's going nowhere. And then it would have been sitting here and you'd be like, oh, I'm right to have sold. And then guess what happens? Up 40%. That's going to cause you psychological torment. It's going to cause you stress. That's going to make your hair whiter than it's ever been. It's going to give you so much stress. And you're going to think, I should have never even bothered investing anyway. It's gambling. It's not a skill. It's whatever. But I'm trying to tell you that by using these things together, you could be well better off, not only financially, but clearly mentally. Like, I would like to say that this has been a very solid time to invest. Months ago, everyone was talking about how everything's falling, it's bad, the sky's falling, world is over. Big tech stocks were down 30%. Google probably down the least of all of them, only 22%. But these big stocks were down 30%, 40%. Nvidia, a big stock, Nvidia was literally pumping all of the time. And now you're telling me Nvidia, a stock like Nvidia was down 22%. Everyone was scared. Everyone was stressed. But if you waited for the right time to buy, and you would have bought, I don't know, at some liquidity sweep, consolidation range, whatever, if you would have just took those 5 minutes to watch these videos and understand, you would have been in a position where you could buy at the very bottom of moves. You'd be in so much less stress. You're thinking, okay, price is going down, it's going down. Maybe it's not at all-time highs anymore, but you'd be sitting in profit. Rather than those people that bought at all-time highs, and now price is sitting around the break-even and they're scared, they don't know what to do. And so I just wanted to make this video to kind of teach you about these daily gaps, these weekly gaps, monthly gaps, and teach you that with combination or in combination with other things, you can further impress yourself in your ability to invest at the right time. Now, I'd really like to do one more example, but I'm not sure I could find one. The only thing I can think of is Meta. Meta. Okay, yeah, Meta. I mean, Meta has just been really doing nothing this past, I don't know, since November. It's kind of just been doing nothing. But what can we see here? At the very least, what can we see here? We can see that, okay, we have this weekly gap. Again, stock like Meta, stock like Amazon, you don't need to combine it with anything. You can, and you can kind of assume that this gap is kind of a liquidity sweep because there's a low and a high here, right? So this specific gap includes in itself a liquidity sweep. What does price do? Geez, all these lines are really cluttered. Let me just do that. You can see the gap here, right? What does price do? Price enters the gap. Yeah, it goes below it a little, but point is price enters the gap. What does it do after entering the gap? Goes higher. Now, I actually want to show you something. In the future, I am going to be talking about take profits, where to take profit, because on Meta, you could have actually secured, literally, you could have bottom ticked Meta and top ticked Meta, which is insane. But I'm literally telling you, you could have bottom ticked and top ticked. You see this gap here. This is where you would have invested. Look at the daily. What do you see here? Right here, this is the weekly gap. You would have invested here. Price would have bounced around, bounced around. What do you see here? There's a gap here. What does price do? Price literally, perfectly, almost to the tick, price goes above the gap. What does it do afterward? It plummets. If you would have taken profit at that gap, you would have made 22%, and you would have been in your positions. Literally, it's like, I don't know, maybe a couple months for you to make 22% on your long-term investment. This was supposed to be long-term, long-term. You would have made 22% on this giant investment, and then you wouldn't be sitting in this minus 25% down move. And again, it all comes to stress. Like, you're saving yourself the stress. You made money and you're out of the position. That's it. But even so, let's say you were still in the position, because like I said, I haven't made a take profit video yet, but you're still in this position. You're thinking, okay, well, this is a pretty steep area to dollar cost average into. Like, where else could I dollar cost average? Well, you can see pretty nice sized consolidation block here. So you can just drag that here. See that, okay, price actually did dip into it. You can see that there's another gap right here. As you can see, I marked off this gap. What did price do? Price filled this gap, went down just a little, and then again, another reaction. Again, signaling that this is a solid investment point. Like, this is a good investment point because price clearly reacted off it. And now what is here? Another gap. And so I don't know. I don't know if price is going to come to fill this gap. No one knows. I mean, I'm not a genie. But if price does, this would be a solid amount to invest into. Because what is at that gap? Right next to that gap, there's also these lows. There's also this consolidation block. And if price so chooses, there's also this high. I'm not saying price is going to go down there, but I'm saying this is a possible place to invest. And so all I really want to tell you is that gaps are very important in the market. Gaps are super important. You can use gaps to find entries. You can use them to find exits. I'll talk about the exit portion later, but the most important part is that if you combine gaps with other features, perhaps if you would have waited for a liquidity sweep or something to happen before this gap, perhaps you wouldn't have even been in this position. If you would have listened to yourself and you would have been like, okay, I'm not going to invest at these gaps because there's nothing supporting them. I'm going to listen to these videos and I'm going to wait for this consolidation block to get hit. What did price do? Price hit the consolidation block. Maybe you were down a tiny bit and then you'd have been up. And then right now you'd have been up when even if you'd have bought at the gap, you'd have been down. So you could constantly improve. You can constantly improve because even in this situation, you could have bought lower than here. And this is already a good place to buy as opposed to buying here. It's all relative. But that's kind of my point. I just wanted to say that gaps, if you use them in conjunction with other things, and if you make sure to use them on very high profile stocks, like not just random stocks that you found on Wall Street Bets. If you use them on very high profile stocks like Meta, Nvidia, Apple, Google, Microsoft, AMD, stuff like that, they could be very beneficial in very kind of optimal entries for you to then invest and then hopefully make some money. And so next video, I might be talking about either how to pair them all together or no, you know what? I actually talked about how to pair them all together. So in the next video, I'll be mostly talking about profit taking. Where could I take profit? Or in the next video, I'll be talking about dollar cost averaging, like how to risk a certain amount on each level to be able to, make the most money out of it, or when to say, you know what, it's probably better to stop dollar cost averaging. It's better to let the investment either settle or kind of just put it outside in the back of your mind. And so, yeah, thank you for watching and I'll see you in the next one. Peace.